Alibaba stock. This is a big stock for the channel. We talk about the stock a lot. If you go look at our past videos, we've done many views of it. Charlie Munger has a big holding through his California company on Alibaba. He sold half of it, but it has recently come out that it's possibly because of a tax loss harvest play that he was doing. So let's go look at Alibaba using our 8-pillar analysis to not only look through all the financials, but also at the end of the video, we're going to go through our stock analyzer tool, the most important part of our software that will tell us what we want to pay for the stock based on our assumptions. So if you have our stock analyzer tool, if you have our software and you're part of our community, follow along. So I'm going to go look up Alibaba. I go to stock search, type in Baba. And remember, we are here to look at Alibaba. So guys, Alibaba hit a peak around 310 back in October of 2020, and it got as low as 73, and now it's currently sitting at 101 or so. Okay, so pillar number 1, we want the 5-year PE ratio to be under 22.5. So on the main page of this thing, of the software, 5-year PE, 18.10. Check mark there. All right, pillar number 2, we want the 5-year return on invested capital being greater than 9%. So again, on the main page here, 11.1%, check mark there. It shows that they're getting a good return on the money invested in the business through debt and equity. All right, before we go to the next one, no dividends here. And we have an average 5-year free cash flow of around 20 billion. And last year they did 21.1 billion. All right, so pillar number 3, very simple. I just want revenue growth over the last 5 years. I don't care if it's a dollar. I just want revenue growth. So I go to our income statement, scroll down just a smidge. Revenue, 37 billion to 126. That's more than $1. That's awesome. That's almost 4 times more revenue. It's 3.5 or so more revenue than it did 5 years ago. Pillar number 4, we want, very simply, net income growth. So we scroll down just a smidge. 5 years ago, they did 9.48. Last year, 8.13. That's an X. But guys, keep in mind, look at this. They had 22.2 and 22.1 in the last 2 years. So immediately I'm going to scroll up and see if there are any write-offs in the last few years. Well, they had a $2 billion write-off and a $3.7 billion special income charge right here. All right, so that's about $5 billion. So it still would have been growth, but technically there was a decrease in net income. So that is an X right now. Now, pillar number 5, guys, this is the silent killer for investing. It's something that very few investors look at. I want their shares outstanding staying the same or decreasing over the last 5 years. So I go to the very bottom and I go to 6 years ago, they had 2.54. Last year, 2.68. So slight increase in their shares outstanding. So that means they're diluting you as an owner. They're increasing the number of shares, not increasing your shares, increasing the total number of shares. So now they're splitting the revenue and profit up by more owners. Doesn't worry me as much because it's such a small increase, but it's still something there to keep in mind. Pillar number 6 has to do with long-term liabilities and the debt the company holds. Guys, debt is the same for companies as for you personally. If you and your neighbor have the exact same house, cars, job, income, family, etc., if you have 0 debt and they have 10 million in debt, who is more likely to have financial problems if the economy slows down? Of course, your neighbor with $10 million in debt. So how do we see how much debt a company has if it's manageable? Well, what I do is I go to the main page, I look at that 5-year average free cash flow. Let's run it up to 20 billion. I multiply that by 5, and I want long-term liabilities under $100 billion. All right? Very simple. So I go to the balance sheet at the very top here. I scroll all the way down to the bottom, and right before total liabilities, there's total long-term liabilities here of $34 billion. We want it under $100 billion. That's a check mark there. So it seems like they have a very manageable long-term liability component, okay? Now, pillars number 7 and 8 have to do with free cash flow. So what is free cash flow? Free cash flow is cash from operations less your capital expenditures. And a company can do one of 5 things with that. They can buy back shares, pay a dividend, pay down debt, reinvest in themselves, or make acquisitions. They can do all 5, none of them, any combination in between. All right, so we go to the cash flow section of our financial statements here. Now, based on the way China reports its numbers, Morningstar is still winning the conversion for all the data to figure out last year's cash flow numbers. So when it comes to our 8 pillars tab, which I'm going to go to right here for pillars 7 and 8, it's going to account for the last full 5 years that it has. So as you can see right here, based on what we see, the only X's we have are a decrease in net income, which we might have seen from the fact they had two major $5 billion write-offs and a slight increase about 1% per year as shares outstanding. So overall, Alibaba is looking good from this perspective. And if you don't have our software and looking into it, this is given for every single company out there. So the question is, how much do you pay? Before we get to that, if you've seen the software, you probably sit there and you've seen our videos, pretty intrigued by it. We've had over 13,000 people sign up for our software, and it's incredible. It does so much for our users. On the main page, these are all the tools that you get and the ones that are coming soon, including our retirement calculator, stock analyzer tool, 8-pillar portfolio, exclusive video content. We make video content for the users in our community every single day that only they get. This software includes 30 years of financial data, all these tools, but most importantly, the Everything Money community. This has thousands of people every single day interacting, talking about their investment ideas. It is too difficult to be on your own island with nobody around you to help you. This allows everybody to come together with the same process and ideology that we talk about here in how you find investments. 20 years ago, I was on my own. I had nobody to guide me. I had to learn the hard way, which was losing lots of money. You will also probably lose money in your lifetime, but if you lose a little less money every single year on your bad investments because of this community, this will pay for itself so easily, and this is all less than 1 cup of coffee every day. 2 ways to sign up, everythingmoney.com, or for our international users, patreon.com. Again, less than 1 cup of coffee per day. So back to it. How do we find out what we pay for Alibaba? So let's go back to our Alibaba search and let's go to our famous stock analyzer tool. Now, every investment is the present value of all future cash flow. This tool is used to enter our assumptions about the future and tell us based on those assumptions what we should pay for the stock. Now, for Alibaba, I'm going to do a 10-year analysis, and you can do anywhere between 1 and 20 years. So the very first line is revenue growth. So in the last 5 years, they've had 35.9% per year, and last year they had 19% revenue growth. I'm going to be very conservative here. I'm going to call it 5. Now I'm going to call it 6, 9, and 12% revenue growth. Profit margin. Last year was a lot lower because of those 2 big write-offs. So I'm going to call it 16, 19, and 22%. Free cash flow, 16, 19, and 22%. Now, PE. Guys, Alibaba's big and growing. So same with the PE and the price of free cash flow. I'm going to pick 14, 16, and 18. Okay? Because China is the fastest growing economy, and it's the biggest company in China with a lot more revenue growth potential. It's the fastest growing economy with the fastest growing middle class. This is going to be a huge economy for the world. And finally, for my desired annual return, 12.5%. Now, you might want to put in 15% if you're a little apprehensive about investing in a foreign company. That's fine. But remember, the higher the desired return, the lower the stock price. Very simply, I'm going to hit the Analyze button. The stock is currently at 101. Boom. Guys, it's all green. All green. So if you like all the assumptions here, and you like what you're doing here, go do more research, but this stock price is looking pretty attractive. Thank you very much for your time. Please don't forget to subscribe to our channel.